Welcome to Greystone Capital Group, where we invite you to embark on an extraordinary journey towards a life of abundance and fulfillment. At Greystone Capital Group, we specialize in the transformative power of passive investing in commercial real estate. Your journey to financial freedom and a fulfilled life begins right here. Subscribe now and let Greystone Capital Group be your guide to shaping a brighter tomorrow.
My friend, to our show, and thank you for coming on the show, Diana.
Thank you for having me here, Jonathan.
Great. Today we want to talk about your background, and then how you got into real estate, and then I guess how do you raise capital for the deals. So let's talk about how you first your background and how do you get into real estate.
Yeah, would love to talk about my background. My previous life before being a full-time real estate investor, I was a full-time architect. So I practiced architecture for a good 10 years. Right in the middle of recession is when I graduated from architecture school. So that was in 2010, 2011, and there was no job for me in the US for architects. Real estate was in the gutter. And so even for my husband, Steven, he was a real estate lawyer and he got laid off at his firm. So it was like both of us kind of in the job sector that's directly tied to real estate, right? So I didn't graduate in the right time. It was the wrong time to be an architect. But what was a good time to be an architect was in China, right? In China, there was a lot of opportunities for architects, and there were buildings getting built so quickly over there that they needed architects. So I decided I'm just going to go to China. So I was born and raised in Houston, right? And then I was in New York for a little bit for school, and I never been to China before. So I always wanted to go and decided that there's a job opportunity, an opportunity to also live in a different foreign country. So I'm just going to pack my bag and just go. So I went there with just literally a duffel bag, like not even boxes and boxes of stuff to move. I just got a duffel bag, moved into Beijing, went online to find a roommate. I could barely, I talk kind of fifth grade Chinese there, and roomed with a stranger, shared an apartment, and started my first job as an architect at this corporate architecture firm for a good 2 years. And so it was a great experience. The whole experience of like building skyscrapers as an entry-level architect was pretty amazing. You don't really get a chance to do that in the US. And, my one experience I remember is that I was working on a 30, 40 story hotel, and we were only in design development, which is, around a 60, 70% of the phase of design, right? And when I was trying to lay out the hotel unit, they were telling me, hey, is this finalized? Because they're pouring concrete now, so the columns are not going to move. So, so this better be the final one, right? I was like, man, we got to still think about how to lay out this hotel room, because you don't want a column in the middle of the unit of the hotel room. But they did it anyways. And so there was like one awkward unit with like a column in the middle, but we had a design around it, right? So that's how fast paced it was in China, right? And so I was kind of used to that. And so when I went back to the US, I was brought down to reality where it was like things are kind of a little bit slower, took a little longer to kind of get to a permit set, and it's a lot more thought out. And I actually got to work on more construction drawings, because in China, when you're a foreigner or a foreign architect, you don't get to work on construction drawings. You do the design, and then you give it to a local design institute to essentially work on the whole construction drawing set. So I never got any sort of experience on even doing detailing, right? So I came back to Texas to continue architecture, got my license, finally got my exposure to working on construction drawing sets. And it was a great experience. My last project I worked on before I left architecture, or at least my firm, is a 252 key hotel in around central Dallas. And that was a project where I actually worked on a conceptual design all the way down to construction ground up. And punch walking during the CA, the construction administration. I just punch walked every hotel room to make sure that the contractor has picked up every little detail, right? So that was kind of my background doing, that was my previous life before I kind of transitioned over to real estate investing.
And what year did you move full time into real estate and left your job, your W-2 job?
Yeah, so that was in 2019. I was actually pregnant with my first kid when I left my
Okay.
architecture firm because I always knew that I wanted to do real estate investing. But when I was pregnant, I just like, okay, if not now, when? So like, because once
Yeah.
I have my first kid, I'm just going to be consumed with like taking care of a newborn. So I actually left during my second trimester when I was pregnant. All right. I just wanted to start networking to build a foundation and to truly kind of grasp how I can get to my first deal.
Mm-hmm.
And so it wasn't a lot of time because in a couple of months, my first kid came out and I was, like I expected, consumed. But it was the first year I actually bought my first single family rental when my first kid was like six months old.
Okay. Okay, great. And then let's talk about your first, I guess, multifamily deal. When did you, I guess, get into that deal as a GP, your first multifamily deal?
Well, before I went to sponsoring, I was my husband and I we were passively investing first, right?
Okay.
So in 2018 is when we started to invest passively into the syndication deals. And so when we were looking into syndication, we knew that we can't be sponsors because we were too busy with our W-2 job. And so the
Mhm.
only avenue to get into investing is to be a passive investor. So it was a great opportunity to kind of understand how the process worked and to learn how to do it, how to kind of see how does other operators do it.
Mhm.
So we invested, we watched, we observed, we learned, and we invested in a couple deals between 2018 and 2019. 2019 is when we kind of paused our passive investing to kind of see this concept, of doubling your money in 5 years actually works, or truth of concept. We wanted to wait to see some of the investment come full cycle, and a few of them actually went full cycle in 2021, right?
Yeah.
So in 3 years instead of 5 years, right?
Mhm.
In 2021, it helps that the market was good. And
Yes.
so a couple deals went full cycle, and we decided, okay, now is we feel like we know enough about multifamily multifamily syndication as an investment tool. Now let's learn how to be an operator, right? So 2021 is when we shifted over from a passive investor to an active sponsor.
Yeah.
We found a mentor to get us our first deal. Our first deal was a 22 unit deal in Glendale, Arizona.
Mhm.
And that's kind of how we started to get into sponsorship.
Okay, good, good. So you're so a traditional route where you become a passive investor. You learn kind of the ropes in a way from afar, just getting updates and hearing what's going on. And then they actually went full cycles. It actually does work.
Yeah.
So now you're convinced that, hey, actually it does work.
Hmm.
And that's why you started going into a GP role more actively to
Right.
get your own first deal. So
Yes.
good.
Yeah. It's funny because in 2021 I was pregnant with my second kid,
Oh, oh,
and
oh.
so uh, it's funny how like each kid gave me more inspiration to do more real estate deals. And like I need to buy more deals so I can get more time to spend time with my kids. So if not now, when, right? So I just kind of hustled taking care of my kid and also sponsoring our first deal. So when we were even raising for our first deal, it was funny because we were staying up late the day before our investor webinar, and Steven, my husband, had like this baby carrier was our 3 month old, attached to him to prep to walk through the investor deck. And because at that time he was crying around like 11 p.m. And so we had to like have him strapped to a baby carrier. So he is a lot more comfortable in a baby carrier and just passes out. But we're just like working, getting ready for our first presentation for the webinar.
Mm-hmm.
But yeah.
Good, 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 Dan. We're glad I see you growing. It's great. Um, and then so let's talk about your raising capital. What was your first deal you raised capital for, and how did you do it, basically?
Yeah. So our first deal was like I mentioned before, the 22 unit deal. And
Mm-hmm.
it was the first time we raised capital. Our partner looked at us and said, can you raise $1 million? Right. And I looked at my husband and was like, I think we can, right? So we never raised capital before in our life, right? We've always been investing in deals. So we didn't truly know what our capability is until we tried on our first deal.
Mm-hmm.
We just wrote down a list of people that we knew that was interested in investing and were, could be a potential lead. And so we just kind of went to work. And what's interesting is that on our first deal, we thought that our investors, or at least the contacts we have met over time as a passive investor from 2018 to 2020,
Mm-hmm.
we thought, we have been collecting their contact information, but more because we were passive investors looking to invest with sponsors. Now it's the script has flipped where we were sponsors, now we need passive investors. And we thought by going to all these meetups and these networking events that we do have a solid list of potential investors from these investor groups, right?
Mm-hmm. Yes.
But when we sent over our deal blast, no one from the past 3 years that we've talked to, right, responded. And only the people that we knew, like friends and family, responded. Because
right.
And then that's what we learned, is that the first deal, it really is going to be boiling down to your friends and family, because the first deal is, you don't have experience, right?
Yeah.
But what you do have is the currency of trust, right?
Right.
So those people that have a better relationship with you and trust you, they're going to be the one who's going to be investing with you, right? So that was pretty surprising to discover during our first raise.
Mm-hmm.
And so we did well in our first raise, surprisingly, and so I think it was helpful for us to kind of build upon that, is to continue to build the existing relationship and continue to stay in contact with them, because I think the previous contacts that we had from 2018 to 2020, we haven't really kept up with them, because we just sort of said hi and we said bye, but we never really cultivated the relationship, right? So in 2021 onward, we were a little bit more, we made a little effort to keep in contact with people and keep them updated about what we're doing, because when our first deal, people just knew us as me as an architect, my husband as in the real estate attorney. They didn't know that we were investors, right? So we haven't put in the effort prior to our first offering that we were now active real estate sponsors. So that was one of the lesson learned, is that for anyone that's looking to raise on their first deal, don't start reaching out to your contacts during a raise. Reach out to your contacts a year before your raise, right? Or even sending them an email or calling them or going on social media to document your journey, to say that you're educating yourself and this is what you learned, right? They know that you're plugged into the investment world, that you are informed about what deal is a good deal, right? So that's something that I kind of wish I did before.
Okay. And I guess you raised for your first deal in Arizona, 22 units. Is that the one you raised for? Okay. Glendale, Arizona. Okay. You actually raised $1 million, basically. Okay.
Yeah.
Good. And how's that going so far, the Glendale, Arizona deal?
It's good. It's been about 1, 2, 3 years since we bought that deal, and so obviously, just like as you would know, this year is not a great time to sell. So we're holding on to it, and we had a pretty good bank loan. It's a fixed interest rate. It's not one of those ARM deals. So we're holding on to it until it's a better time to sell, maybe in year 5.
Was there any management issues or any issues that arise during that 3 years that you found out and learned from that experience?
Well, that particular deal, we have a solid property manager on it, right? This other deal that we have in Dallas, that one is the one probably talking about was a troublesome property manager that we had to let go.
Yeah. So how many months before you realize you had to, let them go, basically?
Well, I mean, I kind of knew by month 3 to 5 that it's not going the right direction, but I think, our team wanted to give them a little bit more chance or time to show or prove themselves, right? We gave them metrics to hit in order for us to continue to work with them. And they didn't hit the metrics. So it really was by month, let me see, 1, 2, 3, 4, 5, 6. It was like month 7 is when we decided that we're going to shop around for other property managers. And we had to basically transition them out to another property manager because they didn't hit the metric that we asked them to,
Right. And
even though we worked closely with them.
And it's very difficult when you do that because you're going to lose maybe some tenants because they're not used to certain ways of doing things that they don't like it. So you might lose some tenants during that process.
Well, you may, or they may be happier because they weren't happy with the other property manager, right?
Yes.
So this new property manager, we had tenants that come up to them, was like, thank God you guys are here because the other property manager was horrible, right? And so we were glad to hear that, but we were also not glad that the property manager before, was not taking care of the residents, right?
Yeah.
So, but during the transition, nobody likes to change property managers. It's a painful process.
Yes.
Because you need to tell them, that we're going to transition you out, and each property manager has their own portal, right? The first one was using Entrada, the second one was using Resman, and both property manager has their own way of bookkeeping. So during the whole transition, we had to give them the financials, but it took a while for them to input the financials. The new property manager took a while to input the financials because they have a different ledger codes, right?
Yeah.
So that took a bit of time to transition, but in the overall aspect, it was a good call on our side to transition them out.
Good. I'm good. I'm glad you solved that. That's one of the biggest issues in multifamily. Good. And you guys realize that. It's good. And 7 months is really not that bad. I mean, if you did it earlier, you would have trusted them out earlier, but it's not too bad.
Right. Did you have any issues on your other properties with having to fire them, the property managers?
I have done that before in my OKC property because they were terrible, and I realized that in the first 2-3 months, and I had to swap them out, and I got a better property manager, and then we sold the property, so we did well on that one. And I learned a lot from those situations, and what are the symptoms you see that's an issue. Because we have weekly KPIs, and it doesn't meet the KPIs, and I know that, and I'll go to surprise visit, and the lady's like not doing her job. I can tell right away. So within like 1 or 2 months, I already know what's happening, and in the second or third month, I started looking for other property managers. But the difficulty in this situation, especially in OKC, is who's a good property manager. That's very hard to find a really good property manager who you can trust. That's hard. It's hard. That's very hard.
Yes. And so one thing I learned too, when I was talking to other operators in DFW, when I was asking around for referrals for these property managers, and there's one lady, she was raving about her one property manager that she had in her second or third deal. And I was like, okay, great. I'm going to remember to ask her if I need to switch. And then a couple months later, well, she also used the same property manager for another deal in a different city. So say like Arlington versus Dallas, right?
Yeah.
And she's using the same property manager. So I was thinking to myself, it should be great, because she already had good experience with that first deal. So the second one with them should be great. A couple months later, I come back. It's like, hey, who's that property manager you recommended? Because I want to talk to them. And then she told me, I don't recommend them anymore because it's the regional manager that are different, right? The regional manager that was in that was managing the Dallas property was stellar. She still likes them there, but the other regional manager that's handling the Arlington property was not doing a good job. In fact, they're actually exiting that property manager in that property, even though she's keeping them on one other property. So even if it's the same company, it doesn't mean that it'll be consistent, right? It's kind of boils down to who's the person behind who's driving the ship, right? So I thought that was kind of interesting because, you would think that it would be relatively consistent, but it's not the case.
And you would think it'd be the same regional because it's not that far. It's not that far away from Dallas to Arlington. It's not that far away, like you think the same region area, right? Dallas region. You wouldn't think it's not Houston and Dallas, so I understand it's different, but that's very interesting. Yeah. So that's why it's difficult, because even though you do one good property, it may not be a good property. So it's very difficult to really know. And you don't know who the regional is until you actually get the regional. And I think that's the issue, right? So
yeah, some property managers are not as flexible to say, okay, that one person that was managing your Dallas deal, we'll use the same person for the Arlington one. That's not always the case, because some companies have a certain system and logic of how they group properties together, making sure that they're relatively close to each other. So if they're not flexible with that, then you don't really have a lot of say on who is managing your property.
Right. Okay, great. Well, I think that's great. So let me ask you some questions. If you ask your younger self now, Diana, what would you do back to your younger self? What advice would you give, and would you have started earlier in real estate investing?
Oh man, it's a great question. And one thing that I wished I did was, back then when I was interested in real estate, I did a lot of reading. I bought a lot of books. I consumed as much as I can. But what I didn't do is to step outside of my architecture bubble of my network of architects that I'm used to talk to other investors, right?
I see.
I didn't know that was, and now I know now, but back then I wasn't aware of this. But what I learned over time is that when you're in a community full of real estate investors, you find a lot of different resources to help get your deal across the finish line.
Yeah.
What I also find is that real estate investors are very supportive of each other, at least the one that I'm part of. And so they give you a lot of references of who to talk to, which vendor to use, and what kind of underwriting parameters to plug into your model, right?
Yeah.
And so if you have a network of supportive community to get you your first deal, or even help you operate your first deal, that itself is valuable. Because when back then I was isolated to just kind of consume what I read online, books, and then try to execute by myself without having a community or having a mentor.
Right.
It didn't work because I didn't know what I was doing wrong, right? Because I was thinking that to myself, I'm a lone wolf. I can do this because I think I'm smart.
Right.
But if you don't know what you're doing, who's gonna, you're not gonna know what you're doing until someone else is coming along the picture and say, hey, you could think about this instead, or try to do this approach because that might help increase your ROI, or this is what you should do to mitigate the risk, right? So even before going to multifamily investing, I was trying to do development, right? So trying to build a duplex, and didn't tap into any mentors, didn't tap into any network of investors. I just did my own interviews of contractors, right, to help me build this thing, and talk to bankers. But it was kind of in a tunnel of just doing my own thing rather than trying to ask for help. And so along the process, it was we saw that we would have to take out $1 million of construction loan, and it was a recourse loan, and it was to us a little bit more of an outsized risk relative to the reward, because at that time, because we were inexperienced, it's like, okay, this is way too risky, because if anything happened to that house, the bank can seize all our personal asset, right? Now, knowing what I know, it's like, yes, they do, but not really, unless you're really doing nothing, right? Just do the work, make it happen, and you're not. It's not going to be as risky if you know that you're going to be able to deliver this product, right?
Right.
Um,
Right.
so I think the fear of failure took over, and we didn't do it. We bought the lot already, but we didn't end up executing on building. We gave it to another developer, right? And
Yeah.
we made some profit, but it wasn't a lot. And over time, this complex, basically, the house could have sold for at least, like, at least both of them, about 1.2, $1.3 million, which should have been a six-figure profit for us, right?
Right.
So I think that when we were paralyzed by fear, we could have tapped into a network of investors to help us calm our fears, and then maybe even take on a partner to mitigate that guarantee on the loan, right?
Right.
It's okay to get 50% of the profit if you don't have to guarantee 50% of the loan, right?
Right.
So that's something I would have told myself, is I should have submerged myself more into the investor community to be able to have a supportive network to understand whether or not my first deal is something that we could have done. And so that's what we did for multifamily syndication. We actually joined a community of multifamily investors, and that's how we even got into our first deal, because we were in that community of investors to understand how to invest into a multifamily deal.
Yeah. So joining a mastermind or mentorship is important because it accelerates your timeline. It gives you more confidence, and someone will watch your shoulder, and help you, guide you through it, which is very important. That's how you succeed in life. It's partnering up, and people will help you along the way because they want you to succeed as well. Whereas I know I was like you in the beginning. I want to be a lone wolf, do it myself, and get all the profit ourselves. But in reality, you should do more who knows what you're doing. So you take less risk, and then you learn over time. You learn, then you become the expert down the road, and you help other people. So.
Yes, and also find what you like doing and do that, and find someone else that will be willing to do the things that you don't like doing. So, for example, for me, I like asset managing, and I like investor relation. My husband doesn't like any of that, but he loves underwriting, right?
Okay.
And for me, I don't like underwriting at all. In fact, I struggle with it because it's not my strong suit, which is why I'm an architect, not an engineer.
Okay.
So,
Okay. That's good.
So we complement each other in our skill set, and so that's something that is worth noting, is when you go into multifamily syndication or operation, find something that you're good at, that you enjoy, and find someone else to do the other side of the job that you don't enjoy doing. Because I think what we find ourselves, especially as multifamily operators, in the beginning, we try to do everything yourself, because we do have to wear all the hats. You do have to have relative knowledge in every aspect, but then you're not going to be good at everything. So as you were saying before, partner with people that will help you with that, and then you can grow together and get to the goal a lot faster.
Right. Well, awesome, Diana. Great tip. So if people reach out to you, do you want to, you see what you're up to and what are going on?
Yeah. So anybody can reach out to me with my email is diana@navi-ventures.com. You can also follow me on LinkedIn. It's Diana Lin, AIA. And you can also follow me on Instagram. It's at Navi_Ventures_RE. And I'm also on Facebook, so just add me.
Okay. Well, say email one time, Diana.
Yeah, Diana, DIANA, at Navi, NAVI-Ventures, VENTURES.com.
Okay, great. Thank you very much.
Thanks for tuning in to the Building Wealth Through Commercial Real Estate with Jonathan Way. If you enjoyed today's episode and want more tips on growing your wealth through real estate, be sure to subscribe. Don't miss out on future insights and success stories. If you're interested in learning about passive investment opportunities, then visit us at www.greystonecapgroup.com. Check back for new episodes. See you again